Hello everyone, welcome to weekly update on the financial market. My name is Tian. February 15 is the President Day and the market is closed. Last week, the bond bears stirred up again as long-dated treasury were hit hard with the 10 and 30-year yields rising to 1.2% and 2% respectively, up from as low as 0.52% and 1.2% last summer. A late romp pushed SP 500 to new fresh high with 1.2% gain for the week and 4.8% so far this year. WTI crude oil ripped again to approach $60 per barrel for the first time since January 2020. Gold edged lower to 1822 an ounce. The Kobe volatility index settled below 20 Friday for the first time since the pandemic almost a year ago. The VIX, or Fear Index as it's better known, closed at 19.97, the lowest since February 21st, 2020, when COVID-19 related fears were beginning to reap investors. The SP 500 index slumped more than 11% in the final week of February 2020. The volatility measure peaked on March 18 at 85.47 and has tumbled 77% since then. Friday's drop of 6% came as the SP 500 rose 0.5%. And this is a positive divergence, stock churning, but the VIX falling. This suggests that fear is residing from the market. With US equity index rising to fresh records again this week, one of Warren Buffett's most famous index come to mind. Investors should be fearful when others are greedy. The Buffett indicator is a simple ratio. The total market capitalization of the US stock divided by the total dollar value of the nation's GDP. First crossed about its previous dot-com peak in 2019. Still, it has been trending higher for decades. But if there's one measure an investor loves, and even more than Buffett it is, the trend is your friend. However, in recent weeks, even that long-term trend fails to justify the metric's appearance, with US market cap more than double the level of estimated GDP for the current quarter. The ratio has surged to the highest ever reading above its long-term trend. According to an analysis by the blog Current Market Valuation, suggesting a strongly overvalued situation. This detachment of Buffett indicator from its long-term trend joins as assortment of other valuation metrics that has also exceeded their previous records in the rebound of pandemic-induced bear market last year, such as price to earning index, price to sales index, price to book market index are among the metrics firmly above dot-com era levels that many investors assume were once in a lifetime peak. Rising valuation are famously bad for timing market tops. Indeed, all tools are. For now, many investors are confident to bet that the recovery from the pandemic will boost some of the denominators in ratio like this, so they are not letting valuation scare them off. Now, the CAPE ratio is also peaking. The CAPE ratio is the cyclically adjusted total return price to earning ratio. It is better known as Shiller's PE, as it was developed by Professor Robert Shiller. In layman's term, what exactly does that mean? Equity valuation in the US are quite high. How high? Going back to 1871, the only periods in history with a CAPE above 39 are as follows. First one, September 1929. Second one, March 1998 to January 2001. And third, today. In September 1929, the CAPE ratio moved above 39 for the first time in history and was a brief one. The same month, the S&P 500 would hit a generational high. From there, it will fall over 68% before bottoming in June 1932. The second time, in March 1998, the CAPE ratio moved above 39 for the second time in history. From there, the S&P 500 would gain another 44% before peaking in March 2000. From the peak in March 2000 to the low in October 2002, the S&P 500 would give back all of those gains and more, declining over 50%. So is this 1929 or 1998? Neither. This is 2021. So no one knows what will happen from here because every time is different. Valuation may be the same as this year's, but the path ahead almost certainly won't be. A stock could either fall tomorrow in the 1929 case, or it could run for a few more years in the 1998 example. Going from overvalued to be much more overvalued, or they could trade in sideways range for years to come, frustrating both the bull and the bears alike. With that said, when the CAPE ratio above 39 or almost the 98% percentile, the investor should be prepared for historically below average forward return and above average forward volatility and above average forward maximum loss. You should know that after the CAPE ratio hits 39 in 1929, the S&P 500 would trade the same level 25 years later in 1954. After CAPE ratio hits 39 in 1998, the S&P 500 would trade the same level 12 years later in 2010. Well, this is not 1929 or 1998, but investors are faced with a similar question. With the CAPE ratio above 39 once more, how many years into the future with S&P 500 current level of 3,900 will be revisited? Well, that's all for today. If you like the content, please subscribe to the channel, and I'll see you next time.